Good evening, everyone. Welcome to our Long Beach State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you tonight. Thanks for taking time out of your busy schedules to get a chance to get connected with us for our class. This is a class we teach 4 times a year. So every quarter we do this for our alumni partnership with Long Beach State. And so we're glad you got a chance to attend this. If you like tonight's content, we'd encourage you to, share this with friends, family, maybe some coworkers that might enjoy learning a little bit more about this path towards homeownership. So we're going to go ahead and dive in. And I just want to kind of let you know a little bit about kind of logistics for tonight's class. We'll run about an hour in tonight's class. It's a very interactive session. So as I roll through the content, feel free to use the chat or Q&A function, and then I'll go ahead and answer any questions live on an air. And then we'll carve out some time at the latter part of tonight's class to do some questioning from you. Now, what I always like to kind of kick off the class is by asking kind of the audience where you're joining us from. So if you feel comfortable sharing in the chat where you're joining us from, what that helps me with is kind of to learn a little bit more about what market you might be looking at from a home ownership perspective, because I know most of us are probably in California, but different parts of California have different, obviously, sales points and whatnot. So if you feel comfortable, put in the chat where you're joining us from. We're going to spend some time looking at some housing data later on. And so it's always kind of interesting or helpful for me, I should say, to be able to kind of learn, maybe where you're considering buying or maybe where you're joining us from. All right. Well, a little bit about our organization. So I work for an organization called American Pacific Mortgage, and we are one of the leaders in home buyer education. And in fact, we provide the most number of first-time buyer loans in the state of California. And we connect with our local communities by serving in like home buyer education. So I teach over 50 classes in homeownership throughout the country, not just in California, but they're really designed to help equip you and give you the support and resources you need to be on that path towards homeownership. So beyond getting a chance to do classes like this, I do originate loans. So we are the mortgage provider. So when you decide to maybe elect a mortgage provider or get on that path towards homeownership, hopefully you'll think about American Pacific Mortgage. And this is a little bit about me. I am based in Northern California, licensed in multiple states, but I work all throughout California. And so when we work with clients, we do a lot over video. So just like you're learning in tonight's class on video, we do the same thing with our guidance with our clients on one-on-ones. So this is a little bit about our talking points for tonight. So we'll spend some time looking at the housing market. We're going to spend some time about looking at some budgeting and figuring out, does really buying make sense for me? We'll spend some time looking at credit. We'll also talk about student loans and how maybe they could impact qualifying. We'll also talk about loan programs, documentation that we want to gather together if we're thinking about maybe considering home ownership, as well as talk a little bit about income qualifying and how that can, maybe direct us in certain products or really, support us, I guess, with our home ownership goals. We'll also talk about first-time buyer programs, especially if you're in the state of California. There's some really great programs offered through the California Housing Finance Agency. So we'll talk about those tonight. And finally, we'll look at kind of the buying process. So after tonight's class, I may say, hey, you know what? I really want to learn a little bit more about what a home buying plan might look like for me. We're going to give you all the tools and resources to take those next steps. Now, for those of you that did get a chance to drop your location in the chat, thank you so much for that. I appreciate that. It helps me really kind of understand. A lot of us, so I got Orange County represent, let's see, LA, Long Beach. All right, awesome. Thank you so much, Whittier. All right, very cool. Chino, Hacienda. So most of us are in Southern California. Okay, cool. All right, great. So a lot of our data that we'll look at in the housing market will be centered around Southern California. So we'll be good there. But if you guys, do have other questions in other markets, I'm more than happy to get a chance to chat about those in tonight's class. All right, well, let's talk a little bit about home buying, because this is probably going to be one of the biggest financial decisions you decide to make in the next, whatever it is, a year, a couple months, whatever the case may be. It's going to be one of those big goals for you in home ownership. Now, there's a lot of great benefits that come along with owning a home. And so when we think about owning a home, we can't really compare that monthly budget to renting, because there's a lot of great ingredients that go into owning a home. For example, the stability in a housing payment. So you're not having to worry about a landlord that's, increasing the rent on you on a monthly basis. So you can kind of control your own destiny with home ownership. This is an asset that hopefully will appreciate over time. So if you purchase a home, that home goes up in value, you continue to pay down your balance. So the difference in those two numbers is home equity. home equity has the opportunity to create generational wealth for you, right? There's also some tax benefits that can still come along with owning a home. So potential interest deduction that you would want to talk to your tax advisor about as well, too. So those are all the things that we have to take into consideration in home ownership. And we do understand that, it is a high cost of living market right now. Affordability is challenging. But for those that can afford to get into the market, there's some really great opportunities that exist in home ownership. And I think as you're considering home ownership, I think a great first place to start is to start doing some budgeting calculating. So we want to do a quick exercise with our class tonight. It's called our rent versus buying calculator. And what we're doing in this calculation, we're kind of looking at comparing a what if scenario around renting versus like what could it look like if I decide to purchase a home. And so I'm going to walk you through this calculator that's brought to us by Freddie Mac. As a quick side note, all of the presentation material will be sent out to you tomorrow morning. So we have your email addresses on file. We're going to go ahead and send you out all the presentation material, and we are recording tonight's class. That'll be up on our YouTube channel. You can find that at J Meda Mortgage. I'll also give you the links for that at the end of tonight's class. So let's look at this calculator, and we're going to first kind of look at the rent side of things. So we just kind of we're going to assume like rent at $3,000 a month. I know. Depends on where you're currently renting, I should say. That rent will vary. We're going to assume some renter's insurance, which in this case we put at $15 a month. We also have expected projections on rental increases at 5% on an annualized basis. And then we plugged in a what if scenario from a home buying perspective. So let's say I purchased a home for $700,000. You're going to learn a little bit more about programs just a little bit later tonight, but the minimum down payment when you buy a $700,000 home is 3% of your purchase price. We have estimated property taxes, which we usually calculate on an estimate of 1.25% of the purchase price. We have expected homeowners insurance, which is at about $1,000 annually. We have maintenance costs that we factor into this budget. So that's all kind of the home buying equation on that side of it. And then we also want to plug in other loan information. So in our scenario here, we assume a 30-year fixed mortgage product. That means my payments are fixed for the full duration of 30 years. We have an interest rate plugged in at 6.75. We'll talk about interest rates in just a bit. And then we have origination costs. So when you do financing, there's origination costs that the lender charges. Now, one of the cool things with our partnership with Long Beach State Alumni and Athletics, we actually discount those charges to you. So we actually discount them by $750 to provide some extra benefit for you. And then there's discount points that you have in a home purchase transaction that you can elect to pay or not. What discount points do is allows you to pay additional costs out of pocket to bring down your interest rate. So let's say, for example, the average interest rate today is 6.75%, but from an affordability perspective, I really need to get to 6.5%. So as a buyer, I can pay additional expenses out of pocket to help bring down that interest rate. Usually 1% of your loan amount is one discount point, and that usually will equate to about a 0.25% reduction in overall interest rate. My thought, though, in today's market with interest rates where they're at, it doesn't really make a lot of sense to buy into interest rate reductions like that because you can't get a good return on investment of that. Usually it takes about 3 to 4 years to break even on those investment funds. And then the last part we want to plug in here is other settlement services. And those are going to be also part of closing costs to purchase a home. Usually we recommend buyers to count or estimate about 2 to 3% of their purchase price for overall closing costs for a home. So when we think about purchasing a home, we have to save up for down payment, plus it's going to be for closing costs. So on the last section here is the other assumptions. So we're going to assume that our home can appreciate about 4% on an annual basis. We factor in the projected time in the home of about 7 years. We're also going to plug in selling costs for the home, state and federal tax rates, and then finally the comparing that with a savings rate, which we put at 3%. You could obviously find higher savings rates. So what this calculator does is it first of all shows a comparison on a monthly basis from a budget perspective. So we know on the rental side, we're about $3,000 a month in rent. Home ownership wise, we're basically double that, right? It's about $6,000 a month if we were including the principal and interest of my loan, taxes and insurance, and projected mortgage insurance since I'm putting less than 20% down. So there's obviously a big increase on the home buying side. However, if I was to look at my opportunity costs over the next 7 years of renting versus buying, there still is upside in homeownership. In fact, I saved $63,000 over the course of 7 years by owning a home versus deciding to rent. Now, the question is, how did I get there? Well, a couple big items. One is we're looking at the equity appreciation over 7 years. And two is we're looking at the tax benefits of owning versus renting. So what I tell buyers that as they're considering buying, we got to actually look at more than just simply the monthly budget. We have to look at all the things, the outcomes that can be about home ownership. Now, for everyone, for certain clients, it may not make sense necessarily to be in today's market, but I think it's helpful to understand what the budgeting looks like in home ownership. So whether you decide to buy in 2024, maybe it's a goal 2 or 3 years down the road, these numbers will help you understand a little bit more about what budgeting looks like for you in home ownership. All right, now let's talk a little bit about the housing market. And so I think there's a lot of talk out there in the housing market. What's going to happen? Are interest rates going to go down? What happens if interest rates go down? Will that change values? Well, the market remains relatively strong right now. I think we still lack inventory in today's market. Believe it or not, there's some good, strong buyer demand out there, even at the interest rate levels that we have today. What you're seeing on screen here is a kind of a snapshot of LA County prices. You can see kind of the median price here. Obviously, there's a wide range of prices, but the median's at $925. You can see, kind of the trend in the market. We're seeing still some uptick in prices. Average day on market is about 36 days on market. So that has kind of ticked up a little bit, but there still is high buyer demand out there. And what I mean by that is, we have buyers that are choosing to get into the market, and many of which are choosing to get into the market because they don't believe interest rates are going to really come down significantly. And if interest rates come down, more than likely prices are going to go up because now you're going to have a new wave of buyers entering the market. So the buyer behavior right now is kind of the thought that they'll get into the market right now before rates drop and prices go up. And so we're seeing a lot of activity in the month of July. You're seeing a lot of people kind of renewing pre-approvals. People that we talked with in 2022 or 2023 are now re-entering the market. And then so the question is, though, what do interest rates do to the housing market? Because to that point, we probably will see interest rates start to drop as we get into the latter part of the year. There's speculation that we may see 2 Federal Reserve rate cuts in 2024, hopefully at least 1 rate cut in the September meeting. But from a general perspective, like if rates start to go down, buyer demand will pick up, and there's only so much inventory out there. So what that will probably do is push prices up even further. So those are things that we want to take into consideration as we're considering home ownership, is what will this interest rate market have on today's housing market. Now, this is a snapshot of interest rates over the last 12 months. You've seen interest rates start to come down a little bit. We peaked at 8% in interest rates back in October of 23. We've had kind of this roller coaster ride of interest rates. You're starting to see interest rates start to improve a little bit here, so that's good news. My thought is, and especially some of the commentary I'm seeing coming out online right now, that we'll probably see at least 1 or 2 rate cuts this year. Some of that gets already baked into mortgage interest rates. You'll see maybe even a month leading up to the Federal Reserve meeting, rates start to come down a little bit. So I think that is certainly on our side from a buying perspective. And if we look at historical levels of interest rates, a historical rate is probably right around the 5.5% level. So we're still certainly well above that. And as we bring down interest rates, affordability will generally improve for buyers. Now, the question is, as we talked about, what does that do from a price perspective? And that kind of remains to be seen. But when we look at interest rates, they're not the same for all buyers. There's various characteristics that go into an interest rate. Credit eligibility plays a role. So the higher my credit score is, potentially the lower my rate could be. The type of product I'm going to select, how much I decide to finance, what my level of down payment is. So if I'm putting 3% down versus 20% down, that could have an impact on my interest rate. The cost that I'm paying out of pocket for points, like we talked about earlier, if I'm deciding to allocate more expenses to bringing down my interest rate, that could impact my interest rate. And then the term of my loan. So if I shorten my term, generally that will bring down my interest rate. So if I decided to go from a 30-year rate loan to maybe a 20-year fixed rate loan, that could help bring down my interest rate. However, in today's market, we have what we call an inverted yield curve. 30-year fixed rates are intersecting short-term rates. And so you're not seeing, the benefit really of going to shorter terms in this market. Now, as we meet with clients for what we call as consultations, we're going to kind of talk through these different characteristics of interest rates to see what rate level makes the most sense for you. But it's important to understand, as a buyer, rates change by the minute. So as the trading day opens on Wall Street, those interest rates will move up and down based upon what's going on with economic data that's coming in, world economic data, I should say, that's coming in. That will move the markets up and down. So an interest rate could be 6.75 one day. The next business day we open up, it could be 7%. It just depends on kind of what's going on economically. All right, any questions about what we've talked about so far before we dive into credit in tonight's class? And again, you can use the chat function or Q&A. Either one works for us. All right, well, if I don't have any questions so far, I'm gonna go ahead and dive into the credit section. And when we think about planning home ownership for our buyers, there can be at times two challenges for home ownership. It could be on the savings side, because I haven't saved up enough maybe for down payment and closing costs, and we have some resources for that to talk through. But it could be also on the credit side, because maybe I'm a little overextended in credit, or maybe I've had some past blemishes on my credit. Those are all things that can impact a future home buyer's path towards home ownership. So we like to, in our classes, talk a little bit about credit, give you some resources, some tools that can help you on the credit side of things. And I think it's important to understand that there are minimum credit scores by product. You can see some of them on screen, whether it's an FHA loan, conventional loan, our veterans product, or the USDA product, or even some of the first-time buyer programs. There are minimum credit score requirements. Now, there are 3 different credit models to be aware of. So there's a credit card model, there's auto financing model, and then there's a mortgage model. For those of you that are using credit monitoring tools like Credit Karma or some of the agency tools, they're generally going to give you the credit card score. But of course, if you're applying for home financing, we're going to use the mortgage model. And here's what that score calculation looks like, or the weighting of the score calculation. So 15% is going to be how long have I had credit. So the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit am I trying to get access to? So am I opening up new accounts? Do I have new inquiries on my credit? And we're talking about hard inquiries of credit. That has a 20% effect on the credit score. Just as a quick side note, as we work with clients, one of the things we start with is a soft credit check. And the difference between a soft credit check and hard credit check is this: soft credit checks only give a lender visibility to your credit, and they don't impact your score, whereas a hard inquiry actually does impact your score. And so we try to really avoid that in working with our clients, because who knows how long it's going to take for our clients to purchase a home. It could be 2 months or maybe even 2 years. And so we want to help be able to educate you without having to impact your scores. 30% is going to be around revolving credit. And so we're talking about utilization of credit. And so if you looked at your credit cards, maybe lines of credit, that's going to be under the utilization category. So let's say, for example, I have $10,000 in limits, and then maybe I'm at a $5,000 in total balances. Currently, I'm at 50% utilization of credit. Ideally, I want to bring that down, okay? So the lower my utilization, the better. The optimal level is 10% utilization of credit. Now, if maybe I'm over on the high side, maybe I'm at 70, 80, maybe 90% utilization, I would encourage a client to try to get that below 50% utilization. That'll really help to uptick the credit score. Now, the credit bureaus collect data at the end of your billing cycle on your credit cards. And so what I would share with you guys is that try to, if you can, when you look at your credit card statement, there's going to be 2 dates on the credit card statements. There's a billing cycle or statement date. There's also a due date. So if it's possible, try to pay down or pay off your credit cards before the end of your billing cycle or statement date, because when you do that, that's going to give a lower balance reported out to the agencies. And then in turn, you're going to have lower utilization, hopefully an improved credit score with that approach. Now, there's 3 different agencies. You guys probably all know them. They're TransUnion, Experian, and Equifax. So they're all reporting. They all have different credit models or risk models that they use. So you're going to have different scores between each one of those agencies. And then, as I mentioned earlier, there's different types of credit scores within each agency. So credit card, auto, and mortgage financing. Now, generally, when you've had past challenges on your credit report, they're going to really impact you in the most recent 12 to 24 months. And so when we look at payment history, which is the biggest impact of the credit weighting, it's 35%. And it's really looking at things in the last 12 to 24 months. So the rating system goes like this. So you have 30-day lates, 60-day lates, and then 90+ day delinquency. So the more severe you're at on that spectrum of days late, the bigger impact you're going to have to your score, but it's in the most recent 12 to 24 months. Now, other credit score factors like maybe bigger events like bankruptcies or short sales or foreclosures, they're going to stay on your credit report for at least 7 years, but they're also going to, because they're larger events, have a bigger impact on your credit score. Now, in lending, we always look at all three scores, but we take the middle score of the agency reports. So for example, let's say I'm at 760 as my top score, my middle score is 740, my lowest score is 720. We're going to take 740 as the mid score for us in qualifying. Now, that's just if I decide to apply in just my name only. Now, let's say my partner wants to join me on the application, but my partner scores are slightly lower. They're at 700, 680, and 660. Well, we're going to use that 680 score because that's the lowest middle score between both of our applications. Okay, so that's pretty important because that can impact your interest rate offering, it can impact your mortgage insurance, and the product that you have available to you. And then the last thing I want to kind of touch on this particular screen is around account closure. And the account closures can affect you from a length of credit perspective, but it can also impact you on utilization. And so what we're talking about is if you decide to close out maybe a credit card, right? You close out that credit card. When you do that, that actually pulls away all the history from the credit bureaus. So when you do that, it can do two things. It can lower your score because of the length of credit, especially if you've had a long-standing credit card that you get rid of because it's now pulled all that history out of the bureau's reporting. But also now you have one less credit line available to you. So it can also impact utilization. So it can almost double hit your score. So you want to be careful closing out credit cards without kind of looking at your total aggregate of totals and of course the maturity dates that you have on your other credit cards. Now, this matrix kind of shows you how long negative items will remain on your credit report. So whether it's a hard inquiry or maybe a late payment or maybe a public record like a tax item, this is how long they'll stay on your credit report. Now, very closely related to credit will be student loans, right? Student loans report to your credit bureaus. And I think, as I work with first-time buyers daily, we have the conversation around student loans because, student loans are just the reality that we have to kind of deal with now. At the same time, there is cancellation of student loan debt, which is great. But we do, if you're in line to get cancellation of debt, or maybe you're not in repayment because you're back in school or you have a forbearance, there still is a minimum payment that has to be factored into the budgeting for home ownership. So, if you're on an income-based repayment program, let's say you have $75,000 in student loan debt, and maybe your income-based repayment amount is, let's say, $250 per month. That $250 gets calculated into your budget as part of your overall obligations that you have to pay. You're going to learn a little bit later about a calculation called debt to income ratio. And what that does, it takes in consideration your pre-tax income, your monthly income, I should say, versus your expenses like the new house and any other expenditures that show up on your credit report. Well, student loans is one of those. And so we can use the IBR payment if you're on one. If you're in deferment or forbearance, by default, we have to take 1% of the total balances to use that as the payment for a conventional loan. Or for an FHA loan, it's 0.5% of the overall balances. So generally, it's in the best interest of the buyer to use the income-based repayment, but I do understand also not all buyers have access to the IBR payment. So again, just to kind of recap here, so if you're in forbearance or deferment, still we have to count a minimum payment for qualifying purposes. And if you're on income-based repayment, that can certainly be used. If you have future cancellation of debt, until that debt gets canceled, then we still have to factor those payments into the monthly budget. All right, let's talk a little bit about loan programs. And there's a variety of different programs out there, but we kind of like to spotlight 5 core programs to help educate our classes. And so I want to kind of give you a little bit of a high level look at each one of these programs because you've probably heard some of the terminology around Fannie Mae and Freddie Mac and FHA and that stuff. But I want to kind of boil it down for you guys to understand how those benefits work with those products. So let's first of all talk about conventional products. So that's under Fannie Mae, Freddie Mac. Those are about 70% of all originations across the country. Minimum down payment for a Fannie Mae, Freddie Mac conventional loan is 3% for first-time buyers. It's 5% for second-time buyers. If you decide to finance more than what we call the conforming limit amount under Fannie Mae or Freddie Mac, it now becomes what we call a conventional high balance loan, which now elevates that minimum down payment from 3% to 5%. And when we look at the conventional product, if we put less than 20% down, you're going to have what we call private mortgage insurance. And you're going to learn a little bit more about PMI in just a bit in our PMI section in tonight's class, but it comes into play when we put less than 20% down to purchase a home. The minimum credit score for a conventional loan is 620. And so that is the kind of the minimum target point for a conventional loan. Now, our buyers have a variety of different options to look at. And so, most first-time buyers are going to be looking at more of a conventional loan or of an FHA product. And so the FHA product can be a great tool for clients as well. It does have a minimum credit or a lower minimum credit score than a conventional loan. It's only 580, has a little bit more flexibility in the guidelines than the conventional product. It does have a minimum down payment of 3.5%. Up to, like in Southern California, for example, we go up to $1.149 million in loan amount. So there is no really kind of high balance distinction like there is on the conventional product. FHA loans, a lot more flexibility from a guideline perspective. It's not just a product for first-time buyers. It can be second and third-time buyers with FHA. Different from a conventional loan, FHA is a government-insured loan versus conventional loan is a privately mortgage-insured loan. And then for the VA product is for our veterans that have eligibility for the VA home loan. The VA product's an awesome product, has a minimum credit score of 620. One of the great things about the VA product, it's here to serve the veteran with a zero down payment option. Some veterans even have an exemption on the VA funding fee, which is even better. And there really is no maximum loan amount on the VA product. You can do $1 million plus on this product and still have a zero down payment option. Conventional loans, FHA, and the VA product, as well as USDA, which we're going to talk about now, are all compatible with various first-time buyer programs that we offer here in the state of California. The USDA product is for clients who are going to purchase in more kind of rural areas. There is 2 requirements on the USDA product, and USDA does stand for the United States Department of Agriculture. So there's an income requirement for the household. There's also geography restrictions. So you do have to buy in more of a rural area. So for example, like let's say you want to live in the desert, like Joshua Tree, that would be like a USDA eligible area. And then for clients that need to finance more than what will be supported by Fannie Mae or Freddie Mac, or maybe even FHA, there's the jumbo loan product. And it's for clients that will have to at least put down 10 to 15% down. It's a much bigger asset contribution on a jumbo loan because these clients are looking to purchase at maybe higher purchase prices. Not typical for a first-time buyer, but the asset requirements are much larger. So higher down payment. Of course, you have your closing costs, but there's also a reserve requirement with a jumbo loan. It requires you to have on reserve the equivalent generally of 12 months of your monthly payment. So if you have, let's say, an $8,000 mortgage payment, you would need 12 times that amount or $96,000 in assets after you've contributed your down payment and your closing costs. Let's talk a little bit about mortgage insurance. And I kind of alluded to it a little bit earlier about PMI and there's government insured mortgage insurance. I want to kind of dive a little deeper into mortgage insurance so you can help you understand it. And if you've already started doing maybe some calculations on sites like Zillow or Redfin and using their calculator tools, those don't necessarily give you the correct data. And a lot of clients get the wrong impression about payments because those aren't really calibrated to what mortgage insurance really looks like. So let's kind of take a little closer look. There is, first of all, different payment options for mortgage insurance with conventional loans. You can pay it monthly. You can pay it upfront. It's called a single premium mortgage insurance. You can also split it between upfront and monthly. You can also build it into your interest rate where you elect to take a higher interest rate in order to buy out your mortgage insurance. 95% of the clients I work with will elect the monthly mortgage insurance premium. And the reason why that is because it has a cancellation option. So once you get to 2 years in your home and you've accrued 22% equity, you can apply to have mortgage insurance canceled. Now, to my point earlier about Zillow and Redfin, these the mortgage insurance is not it's not calibrated correctly in those calculators because PMI has a few different factors that make up the premium cost for you as a buyer. One is it factors in how much you put down. It also looks at what your credit score is and then how much you finance. So that can change the premium. So if we looked at like a conventional PMI example, I have it here on screen, which is if we finance that 700,000, we put down 3% and we had, let's say, a credit score of 740, your PMI on a monthly basis is about $209 a month. So if you did that same calculation online, it might look a little bit higher because in this example, we're taking in consideration, those characteristics around credit score, down payment, and amount financed. Now, if we look at an FHA government insured loan, the mortgage insurance looks a little bit different because there's two forms of mortgage insurance on FHA. There's upfront mortgage insurance, plus there's monthly mortgage insurance. The monthly is 0.55% of our loan amount, and then the upfront is 1.75% of our loan amount. Now, different than a conventional loan, FHA does not have a mortgage insurance cancellation aspect to it. So the only way you can exit mortgage insurance on an FHA loan is to refinance out of the loan into maybe, say, a conventional loan. So we really use the FHA loan as kind of a springboard into homeownership, not necessarily the long-term solution. It's to allow buyers to get access to homeownership. And then hopefully, as things change financially for them, we can look to refinance maybe into a conventional loan product. Now, this is what the same example on purchase price looks like now using the FHA product. So if we took 700,000 as our amount finance, down payment, as you remember from earlier on an FHA loan is 3.5%. So we have the monthly mortgage insurance at $320.83. And then different with FHA, we have to add on upfront mortgage insurance of $12,250 into our total amount finance. So it will make the FHA product a little bit more expensive. What you will see if you do like a search on FHA interest rates versus conventional rates, the interest rate on an FHA loan will look a little bit lower, which is a little bit deceiving because as a buyer, you don't really see what's behind the scenes because the FHA mortgage insurance expense-wise will be more expensive than the conventional product because of the mortgage insurance calculation. Now, at the same time, I think it's important to understand that, it depends on what the best fit is for you as a buyer because not all of our clients will qualify into the conventional product. And I think FHA is a really good alternative for clients, especially maybe if there's credit score challenges, maybe there's some late payment challenges. FHA will allow a lot more flexibility as opposed to the conventional product. But as we meet with our clients for consultations, we're going to kind of design some home buying options as part of your plan and kind of figure out what the best path is for you to achieve home ownership. Now, as we design that path towards homeownership or that plan towards homeownership, we're going to talk through employment and income. So I want to share with you two things. One is just the typical documents that we ask for, you can see on screen as it relates to income. So 2 years of taxes if you're self-employed, 2 years of W-2s for W-2 employees. From an asset perspective, we usually ask for bank statements, and then last 60 days of pay stubs. Okay, so that's usually what we're going to ask for in terms of the typical documents. And then when we look at employment history, that's one of the things that comes up in our conversations with clients. Now, as a self-employed client, you do have to have at least 2 years self-employed and showing 2 years of tax filings. Now, as a employee of a company, we do have to require 2 years of employment and or educational history. So, there's a misconception out there that you have to have 2 years on your job, which just isn't the case. So if you graduated, let's say from Long Beach State with a 4-year degree, and now you just started your job first of the year, because you have your educational background and now you started your new job, we can use that employment history right away from a qualifying perspective. And that was actually one of the questions we had in the chat, which was, how does job history affect your loan prospects? What if you change jobs before applying for a loan or in the middle of the process? So that kind of leads me to my next point. So a great question from the audience. So if you change jobs, we still just have to show that work history. So as long as it's a like job, like similar base salary or higher, if it's a variable compensation job, like let's say it's a base plus commissions or base plus bonuses and commissions, we do have to show that you've been on the job 2 years if you want to factor in that variable income into the calculation for your income. And then the 2-year rule does come in effect if we have dual employment. So some of our clients that work maybe in the healthcare industry that work for multiple employers, we do have to show in that case that they've been working for the same or those 2 employers simultaneously for 2 years. Now, if I work for a W-2 job, 40 hours a week, and then I maybe drive for Uber on the side, make some additional cash that way, you can use that income. However, you do have to show that you've been doing both jobs simultaneously for 2 years. All right, now I got a couple of questions in the chat here. I'm going to get to. Let me just make sure. So let me answer this question. Which is, does time off work for maternity leave affect your job history, even if you return to work? So it doesn't actually affect you at all. Depends on when your return to work date is, and just as long as we can verify that you actually return to the same position, your existing compensation plan can be used. So generally, when you go out on leave, you're going to receive probably a disability plus partial pay from your employer. That can be used to qualify you, and or your existing current pay structure that you had before you went out for maternity leave. Okay, all right, good question there. I'm going to answer this question. I know it's not in the same income space, but I'm going to answer it really quick so we don't forget it. So a question from our audience was, how would a person use equity to purchase a second property? So what we're talking about, that would be for someone that's an existing homeowner that's trying to kind of leverage an existing asset to purchase something else. Generally, you would maybe take out a line of credit to access that equity and then use that line of credit to put down towards the next house as a down payment. Okay. One thing I want to touch on income before we continue on to talk about debt to income ratio is around additional income sources. So at times we'll have clients that have partners that are contributing to the household, but don't necessarily want to be on the application. Unfortunately, in order to count their income to the equation, we would have to have them a part of the application. Same thing holds true if you're collecting maybe room rents for your existing place. Unless you're purchasing like a multi-unit property as a first-time buyer, we can't transfer over that expected income you're getting as room and board right now into the homeownership calculation. All right. Let's talk a little bit about debt to income ratio. You may have even heard about this calculation before tonight's class, but it's a real simple calculation. It takes into consideration your gross monthly income versus your monthly expenses. Most expenses that will show up on your credit report, like personal loans, student loans, credit cards, car loans, things of that nature. It looks at the principal and interest, and you can see it on screen here, the principal and interest, taxes, and insurance for my new house. PMI if I'm putting less than 20% down, or maybe I'm using an FHA product. Homeowners Association dues if I'm buying maybe a condo, maybe a townhouse. And then we look at other debts, like I said, the student loans, personal loans, credit cards. And then we take that versus your pre-tax income. So we have an example on screen. This particular client has a $3,000 expense side of things versus $8,500 in income. So they're currently at a 35.29% debt to income ratio. So that's a calculation that we use as lenders. That debt to income ratio generally can't be higher than 45%. At some cases, we can go as high as 50%. The question I get from clients is, well, where should my debt to income ratio be? I see from most clients the sweet spot being anywhere between 33 to 36% typically. Now, I think the important thing, the takeaway there from debt to income ratio is we want you just to understand, like, how do lenders calculate that number? What's most important for us is that we're designing affordability or affordable home options for you as a buyer, because we want to make sure homeownership is affordable, number one, and two, that it's sustainable over time. So debt to income ratio is simply just a metric for qualifying purposes. The conversation we have during a consultation will be centered more around affordability. Now, last component to homeownership is savings. So really the assets that we'll need for down payment and closing costs. This is some of the typical documentation that we'll ask for your down payment to be able to support the assets that we're using for that, as well as closing costs. You can also access funds in retirement accounts like 401ks, 403bs, even IRA accounts. I would encourage you to talk to your tax or financial advisor to get guidance on whether those assets are right for you to use in homeownership. Family members can also contribute. We call those gift funds. That happens all the time in homeownership. There's a way we document those gift funds, which is pretty simple. The donor has to complete a gift letter, and then we just show the transfer of funds. When you heard me talk a little bit about the two challenges for homeownership, it was either credit or just savings. What I like to do in our classes is just kind of give you a really simple approach to a savings plan to maybe help you get on that path towards homeownership. We are going to talk about first-time buyer programs in just a minute, but I want to give you kind of a quick little approach to a savings plan. And here's how that goes. So if you're currently, let's say, we'll just kind of give you some numbers. Let's say you're spending $2,000 a month in rent. And after meeting with us, you feel like, hey, I can support myself with about a $3,000 a month mortgage payment, right? So currently there's a gap of about $1,000. So if we're trying to build into homeownership in the next year or two, what I would encourage that client to do is start paying like you're paying a mortgage payment of $3,000 a month, but pay that to yourself. So after you pay your $2,000 a month in rent, that start budgeting yourself to pay that additional $1,000 into your savings account. And before you know it, after 6 months, now I've seen $6,000 grow into my savings account. After a year, that's 12 months. Maybe it's going to take me 2 years to save for homeownership, and now I've accrued $24,000, not including high yield interest accounts that you have out there available to you. So that's what I would kind of really encourage you guys to think about in terms of a savings plan. And really what that does, not only are you accruing more savings, but you're creating that discipline for you for a budget of homeownership. So when I do decide to buy my house, that leap from $2,000 a month to $3,000 isn't such a big jump, right? Because we've been demonstrating the behaviors of doing that over the last several months. All right. I'm going to answer one more question before we go into, okay, so we got that. Okay, I had one more question that came in the chat, which was the last 2 months of statements was mentioned a few times. Any tips on how to make sure your statements look the best positive or / positive before applying for a loan? The reason why we're asking for 2-month statements is because assets are required to be seasoned 60 days. So if you've had any like cash deposits or things that basically can't be paper trailed, we want to talk through that a little bit because we're looking to be able to see a 60-day asset track record that's all kind of clean deposits that we can kind of source the origination of those funds. All right, great question. So with that challenge and maybe saving towards homeownership, there's some wonderful first-time buyer programs that can help supplement what you need for homeownership. And we're proud to be the #1 partner of CalHFA, which CalHFA is a state agency, which CalHFA, by the way, stands for California Housing Finance Agency. It's designed to help support low to moderate income households in homeownership. There's a variety of different programs that are offered through CalHFA. You may have heard about one of the programs that's actually being funded right now called Dream for All. It had a lot of attention on the news outlets and social media. And so that Dream for All program is currently, we have buyers that are now, they've received vouchers for that program and are shopping for homes. It's not a program that's available right now for new buyers. Hopefully that product will be refunded again by the state in 2025, but right now it's not accessible. But I do want to share with you some of the existing programs that are available with CalHFA. So the first program is MyHome, and what MyHome does is it provides support for you with both your down payment or primarily for your down payment, but can also go towards closing costs for your home purchase. It's up to 3% of your sales price for a conventional loan, 3.5% for an FHA loan. And what it is, it's a separate loan that the state provides to you at a 1% simple interest rate loan. Those funds that you get through that program are not repaid until you either sell your home or if you decide to refinance in the future. There's two big benefits with CalHFA. One is the assistance, like we're mentioning right now, but also the rates tend to be a little bit lower with the CalHFA program than a market rate. So if someone was to purchase using a standard conventional loan at 3%, today's interest rate would probably be north of 7%, like 7.25%, right? If you took that same conventional product and used the CalHFA first-time buyer program, that rate is closer to 6.625%. So huge difference there from a rate perspective. So it's designed to help provide more affordability to our first-time buyers. Now, if a buyer needs more support in terms of assets or resources, there's also the ZIP assistance program that provides up to 2 to 3% of your sales price 2 to 3% of your loan amount in assistance. It's interest-free assistance. The way that program works, it's kind of an add-on to the My Home Assistance program. So you have to first approach the My Home as one of your resources. If you need additional funding, that's when ZIP assistance comes into play. Now, in today's market where interest rates are higher than historical averages, ZIP is one of those products that will really elevate the first mortgage rate. In fact, today it would take that rate above 7%. So we don't necessarily recommend ZIP assistance right now unless we absolutely have to for a first-time buyer. Usually we're kind of centered on looking at the My Home Assistance program because it, again, giving those two benefits of the low interest rate assistance plus a lower interest rate on your first mortgage. So just an awesome product that's offered through CalHFA. And being the leading provider of CalHFA, we'll help you kind of understand like how to best use that support for you on your path towards homeownership. Now, there are income limits for the program because it is a first-time buyer program. Here's some of the income limits by county in our southern part of the state. These income limits are at 150% of the median income level for your particular county. I did see some, I think there's a guest that's joining us from Sacramento. Sacramento's right around 225 in income limits. If you're in some of our Bay Area counties, it's up to 300,000 in income limits. Now, we'll talk more about income limits for the program in just a bit, but the income limits are based upon applicant, not the entire household income. So that's one of the big benefits with CalHFA. So for example, if you have a dual income household, and let's say I'm going to buy in LA County, right? And I make 180,000 a year and my spouse makes 100,000 a year. Well, combined income, we're over the limits. However, if I just apply in just my name, then I would be within those income limits for LA County. Now, here's an example of how the program looks from a numbers perspective. So if we bought that same house for 700,000, we had a 3% down payment, and then we had factored in closing costs, which, as I mentioned earlier, I would factor in about 2 to 3% of the sales price for estimated closing costs. We're probably looking without an assistance program at about $35,000 to $42,000 out of pocket expense. Now, if I overlaid the My Home Assistance program and used a first-time buyer resource, now I'm going to have that $21,000 in My Home Assistance to augment my out-of-pocket, right? So now I can have my down payment covered at $21,000. If I only use My Home Assistance, then I basically would just have to worry about my closing costs out of pocket. So instead of like contributing that $35,000 to $42,000, maybe that number is $14,000 to $21,000. Then, of course, if we needed some more resources, we could always look at the ZIP assistance program as a scenario as well, too. So here's kind of the guidelines for the CalHFA product. So it's a first-time buyer product. What a first-time buyer means is I have not owned a home in the last 3 years. There are minimum credit score requirements. So for the FHA product offered under CalHFA, it's 640, conventional at 680. And if I'm considered low-income housing, it's a minimum credit score of 660. Debt to income ratio goes anywhere between 45 to 50% on these programs. We talked a little bit about the income qualifications earlier, so it's based upon applicant, not necessarily household size. And this is available for all types of products, but it has to be a one-unit property. So single-family homes, condos, townhouses, even manufactured homes can be eligible, but manufactured homes have to be on land that you own in order to use the product. All right. So that's the CalHFA first-time homebuyer resources. Really encourage you to check out that. That's a really great opportunity for you as first-time buyers. And these programs are always available through CalHFA. Let's talk a little bit about the buying process. So after attending tonight's class, really kind of helping you understand what the path looks like for you towards homeownership, we want to kind of give you a visual aid to help you understand the path towards homeownership. This is our 6 steps of home buying. And just to kind of give you a sense of what this looks like and kind of where you go from here. So after tonight's class, we would encourage you to get connected with us for a consultation. A consultation is a 30-minute session we do over video. And then after we meet with you over video, generally we will be issuing what we call as a pre-approval. So whether you plan on buying next month or even next year, we would want to help you kind of create a baseline for you for eligibility. And that's called a pre-approval. The pre-approval allows you to make offers on a home. A pre-approval is usually good for 60 days, but it can be recertified at any time. But it just gives you a sense of, what am I qualified for as a buyer? And then depending on when you decide to go out and start looking at homes, that would be the next step, which is called house hunting. And that house hunting could take 2 or 3 months. It could take 2 or 3 weeks, or maybe even a couple of years. Just depends on what communities you're looking at. We're here to help support you through that process. Many of our buyers are buying on the weekends or looking on the weekends. So, we're meeting with clients on text or communicating with our clients on text or phone throughout the weekends. We have clients that need that support. And so we always have team members on call to help update items that they need as they go through their house hunting, because there's payment scenarios that we run while you're going through the house hunting. You may find a house that you like at 600,000, and we're trying to show you what the numbers look like to help support you to make sure that's within your budget. As you decide to go house hunting, it's probably going to go from online to maybe looking in person. And we would encourage you to connect with a realtor to start doing that looking. We have preferred realtors as part of our network across the country, most so, in the California markets, of trained first-time buyer preferred realtors that we can connect you with in that home shopping phase. And so as you continue to move through this process of home buying, once you find a home and you present an offer, if that offer gets accepted, then we move to step 3. That means you now have a ratified agreement with a seller. And so there's a contract that agrees to the terms of the purchase of that home and sets some timelines in place. The day we receive correspondence on that contract, you're going to get a call from me saying, congratulations, you did it. Now it's going to this will be the start forward in the process. So what we'll do is we'll meet up for a follow-up consultation once you have an accepted offer, just to make sure you understand your numbers, your disclosures. What numbers would include your out-of-pocket expense? What do interest rates look like for you at that time? And then we kind of start the processing of the loan, some of the administrative work. Now, as a buyer, you'll be responsible to contribute what we call an earnest money deposit, usually in the first 2 to 3 days of your contract period. Depends on the part of the state that you're buying in. So whether you're buying in the Bay Area, Sacramento, or Southern California, the earnest money deposit could look a little bit different, but usually it's 1 to 2% of your purchase price. Those funds will count towards your total out-of-pocket. So when we think about down payment and closing costs, that earnest money deposit will count towards that. Now, inside of your contract, there's a thing called a contingency period. And the contingency allows you to do your homework on the property, which includes getting your house appraised, because we want to make sure the house is worth what you're buying it for, getting your house inspected. So we're going to go through an inspection series. Your realtor will help orchestrate that. And then finally, we're going to want to get your loan approved. And the loan approval comes back and says, you know what, Jason's all checked out on the financing. We've reviewed his income, assets, or credit. We're all set and good to go. And so that's happening behind the scenes. Generally, that contingency period is in the first 14 to 17 days of your contract period. It can be shorter at times, depending on the competitive nature of the negotiations with the seller. Now, step 4 is the administrative functions of us, which we're doing some verifications of employment, assets. We're probably locking in your interest rate at that time. It's important to know as a buyer that interest rates vary during your home search phase. So until you have an accepted offer, for most products, we're not locking in the interest rate until we have an accepted offer. And then step 5 gets us closer to the finish line. Step 5 is going to be, now the loan approval has been issued, you have your inspections back, we have your appraisal back, and now you're probably at the end of that contingency period. And if everything kind of checks out, like you feel good about all the work that's been looked at behind the scenes, then you're going to sign off on your contingency. That tells the seller that you've done your investigative work and now you're ready to move to the final stages. It also prompts us to issue you what we call as the closing disclosure. On the lending side, that closing disclosure gives you a 3-day cooling off period to make sure everything aligns with all your disclosures that you've seen throughout the process before we get to the final stages, which is called closing the loan. Just as a side note, all disclosures are all electronically delivered to you and e-signed. However, when you get to step 6, the closing of the loan, it's still kind of an old school process. It's in person with a public notary. Usually takes about an hour or so. You're signing final documents, wet signature, and your signatures are being notarized. Those documents get now sent back to us after they're completed for audit. And then once that audit is completed, we wire in the funds of the mortgage. At the same time, as a buyer, you're wiring in your final funds that you have as part of your transaction. Those monies get reconciled by an escrow team here in California, and then documents get recorded with the county recorder's office. Generally, they record a grant deed to transfer ownership, as well as a deed for your loan for your financing. And so once that's all completed, then we get a chance to celebrate because now you become a new homeowner. And that's one of the best days, because we get a chance to, celebrate this huge victory, because you've gone from maybe a class that you've attended to, like tonight's class, to go from pre-approval to find a house, get an accepted offer, and then get to the finish line of owning a home. It's a huge accomplishment. As I mentioned earlier in the beginning of tonight's class, it's probably going to be one of the biggest financial goals that you hit in your lifetime, really. And so as you're thinking about, maybe, do I move forward? Do I want to kind of put some goals and objectives together for me in homeownership? We'd encourage you, get connected with us. We provide free consultations for the attendees of our classes. It's a 30-minute one-on-one with me. It's a real simple process that starts with an online application. We'll have all the links to you, as you can see on screen. We only do a soft credit check to help kind of, understand where you're at financially, and then you upload documents, and then we'll get a chance to meet for your session. If you have some follow-up questions from tonight's class, maybe you didn't get a chance to ask those questions in the chat, get connected with us for an introductory call. That's where we get a chance to just answer, maybe you have a scenario question that you want to run by myself or one of our team members, or you have more questions about the first-time buyer program. Definitely book an introductory call with us. All the links for that is all found in all of our presentation material. Here's what a consultation looks like. You've already heard me talk a little bit more about it, but it's allowing you to kind of see what your goal looks like, your goals look like, what a budget might look like for you. Do some of the first-time buyer programs fit for me? Do I need some improvement around credit, or how can I maximize my credit score to get the best financing? All those things we'll discover as part of your free consultation with us. Now, we have other resources available to you, like our mobile app tools. You can start the application process via mobile. You can follow the progress of your loan via mobile. There's also some really good calculators that you can use as you're doing your home search. And so as we're getting towards the end of tonight's class, we're almost to the top of the hour. We do appreciate you staying connected with us throughout this class and over the last hour. We're really proud of our partnership with Long Beach State Alumni and Athletics. We also have other partnerships across the country that we have on screen. So like I said earlier, if you have friends, family, or coworkers that want to be able to attend one of these classes, these are free services to our communities to help educate our future first-time home buyers. And so this is some of our other schools that we partner with across the state, as well as we pass along discounts to state employees here in California. Here's all my contact information. So if you do have questions and you want to get connected with me for a question, or maybe a follow-up from tonight's class, you can just always email, text, call, whatever's good for you. And of course, we have our scheduling system that you can book an appointment either for that consultation or an introductory call. And we're really proud about what our communities say about us in homeownership. We don't take our role in this our responsibility to support you as buyers lightly. Not only do we provide our educational tools, but we're providing an experience for you as a buyer. So we'd encourage you to check out some of our reviews on Google, some of our testimonials on Instagram, and we encourage you to follow us on Instagram. We have a lot of good information out there that we try to provide those resources for you as first-time buyers. We're trying to post once or twice a week to give you more information on what homeownership could look like for you. So with that, I know we have many of us that are still sticking around. I want to open it up for Q&A before we leave tonight's class. I do appreciate everyone kind of staying tuned in. But if you have a question that I can help answer on in tonight's class, feel free to drop that in the chat or Q&A, and we'll get those answered on air before we break for the night. Okay, any questions? I know maybe some of you are typing away here, so I'll give you a second. I think we got most of those. One of the things that is kind of a hot topic in the lending industry, I thought I'd just share with you. In fact, one of our videos we have launching, I think tomorrow or the next day on Instagram, is about condominiums. So there are condominiums in today's market with affordability challenges can be a choice for you as a first-time buyer. But I think it's important to understand that, condominiums come with expenses like homeowners association dues. So you want to factor that into your budget. So even though the condominium might be at a lower price point, when you factor in HOAs, that could raise that payment a little bit. On the other side of it, condominiums, when you purchase into an HOA community, you are kind of a member of that community, right? So when we lend there, it's not necessarily just lending on your unit, it's the entire community. And so what we're finding in some cases in certain communities that, some of those HOA communities are not set up necessarily financially in the best position. Sometimes the conditions of those communities are not up to the expectations that we have or guidelines that we need to meet Fannie Mae or Freddie Mac guidelines. And so I share that with you because there is a Senate bill coming out, or that's already out, that requires HOAs to retrofit all their railings and stairwells in condo communities. And so that has to be, inspections have to be done by 2025. So we're finding a lot of HOA communities that aren't necessarily ready to go right now. And so those are some of the things that we have to do in lending on condos. So I thought I would share that with the group because, that can be a choice for you in your home ownership goals. Not that there's anything wrong with condos. It's just, we do a little bit more due diligence for you as a buyer, because again, when you're purchasing a condo, you're buying into the community, not just necessarily your unit. Okay, question came in, which is, can you be a first-time home buyer and rent out the property? Does that have any impact on the loan considerations? So you can't use a first-time buyer program and then turn around and rent out the property. So, you are, using state funds to help create affordable home ownership. So you can't turn around and make it an investment property. It's really designed to create, affordable home ownership for you. Usually most first-time buyer programs require you to at least live in the property for the 12 months before you can convert that into a different type of property. But with first-time buyer programs, there's usually restrictions on investment properties without permission by, like, say, a state agency. All right, great question. Any other questions before we sign off tonight? Okay, let me just make sure I got okay. Actually, I think I missed a question here. I got two questions before we sign off here. So one question was, are mortgage lenders okay if there's a layoff in your 2-year work history? If so, what duration are more tolerated? So, at times there can be layoffs in a work history. So if as long as we can document the reasoning for the layoff, and usually it comes with a letter of explanation from the buyer, there shouldn't be an issue. If you're out of the workforce for a significant period of time, like let's say over 2 years, we would want to kind of better understand that. But, given, the challenges of the pandemic and whatnot, obviously there was layoffs that occurred, rightfully so. There could be some layoff there. So we can certainly document that through a letter of explanation. And then I think we got one more question, then we'll sign off here, which is, if you take on a line of credit and then in addition to a mortgage loan for financing, the loan, let's see, the loan. Okay, so I think this might be a follow-up question to the question about accessing equity. So if you take out an equity line plus you already have an existing mortgage, yes, you would have 2 loans in that case. So you have to pay a first mortgage plus a line of credit. That's if you are an existing homeowner. To that point, on first-time buyer programs, you do have a first mortgage, and then you have, let's say, the MyHome Assistance. That MyHome Assistance program is a second lien position product. However, there are no payments required on that until you either sell the home or if you refinance in the future. Okay, I'll finish with this one because this came in which was my advice on kind of savings for a down payment. I'll kind of give you guys that savings plan discipline that I shared with, and then we'll wrap it up for tonight. But ultimately, kind of what I coach clients on is creating a savings plan for yourself. So for example, if you pay, let's say, $2,000 a month in rent, but you're maybe comfortable going to maybe $3,000 from a mortgage perspective, now you have a variance of $1,000. So what I would create the discipline of is paying myself at a $3,000 level and taking that $1,000 surplus that I have and parking that in my savings account on a monthly basis. So as I, do that on a month in, month out basis, after 6 months, I've accrued $6,000 in savings. 12 months, I have $12,000, right? And so it not only builds that savings, but it also gets you in the discipline of paying that higher mortgage payment. So when it comes to home ownership, it's not such a big leap to go from $2,000 a month to $3,000. All right. Okay. Well, thank you so much for everybody tuning in. It was great seeing everyone in tonight's class. Look forward to hopefully connecting with you for a consultation. Thanks again for tuning in, and we'll talk to you soon. Have a good night.